There is a profound and unsettling paradox at the heart of the modern financial world. We are told relentlessly, from every corner of the media, from every financial news network, from every guru with a newsletter, that the path to wealth is paved with genius. It is a path of brilliant moves, of finding the next Amazon before anyone else, of executing a trade so perfectly timed it becomes the stuff of legend. We are sold the idea of the home run, the 500-foot shot that clears the stands and wins the game in a single glorious swing. And so, the average person, the retail investor, the entrepreneur trying to manage their capital, steps up to the plate, grips the bat as tightly as they can, and swings for the fences with every ounce of their being. More often than not, they strike out. They don't just strike out. They are financially and emotionally devastated, their confidence shattered, their capital permanently impaired. They blame the market, they blame the system, they blame bad luck, but the truth is, they were playing the wrong game. Warren Buffett, arguably the most successful investor in human history, built an empire not by hitting 500-foot home runs, but by understanding a secret that is so simple, so fundamental, that the vast majority of market participants overlook it their entire lives. He understood that investing is not a game of brilliance, but a game of survival. It is not about making a few spectacular winning moves. It is about systematically, ruthlessly, and relentlessly avoiding a few catastrophic losing moves. His entire philosophy, the bedrock of the Berkshire Hathaway empire, can be distilled into a powerful not-to-do list. A set of unforced errors that, if simply avoided, place you in the top decile of all investors by default. He knows that long-term portfolio growth isn't about what you do, but about what you don't do. The journey to financial freedom is not a sprint for glory, but a marathon of capital preservation. You don't need to be a genius, you just need to not be a fool. You need to understand that the surest path to winning the game is to first ensure you never get taken out of it. This is the final promise of a rational mind in an irrational market. Survive first, and the compounding will take care of itself. Today, we deconstruct that not-to-do list. We will not learn how to be brilliant. We will learn how to not be stupid. And in doing so, we will uncover the single most powerful investment strategy ever devised. Our exploration is divided into 5 fundamental pillars, 5 cardinal sins of investing that Buffett has spent a lifetime avoiding. Each one is a leak in the boat of your financial future. By plugging these 5 holes, you create a vessel capable of navigating any storm and reaching the distant shore of true wealth. The first, and perhaps most catastrophic of these errors, is the seductive, intoxicating, and ultimately fatal sin of leverage. It is the belief that you can accelerate your journey by borrowing against the future, a mistake that has wiped out more smart people than any other single factor in the history of finance. It was the late summer of 1998, and the financial world was holding its breath. In a nondescript office in Greenwich, Connecticut, a ticking time bomb was about to detonate, threatening to take the entire global financial system down with it. This wasn't the office of some fly-by-night trading outfit. It was the headquarters of Long-Term Capital Management, or LTCM, and it wasn't run by fools. It was run by a team so intellectually brilliant they were dubbed the Mount Rushmore of finance. The firm was founded by John Meriwether, the legendary former head of bond trading at Salomon Brothers. On his board were 2 men, Robert Merton and Myron Scholes, who had won the Nobel Prize in Economics just the year before for their groundbreaking work on options pricing, the famous Black-Scholes model. These weren't just smart guys, they were the men who wrote the textbooks. They had created complex quantitative models that they believed had unlocked the secrets of the market, allowing them to spot tiny temporary mispricings in global bond markets and profit from them with near certainty. Their strategy was called arbitrage, and in theory, it was virtually risk-free. They would buy an undervalued bond and sell an overvalued, similar bond and wait for their prices to inevitably converge, pocketing the small difference. The problem was these differences, or spreads, were razor thin. To make real money, they needed to make enormous bets. And to make enormous bets, they needed enormous amounts of capital. So they turned to the oldest and most dangerous tool in the financial toolbox: leverage. They borrowed money, lots of it. For every $1 of their own capital, they borrowed over $25 from the biggest banks on Wall Street. Their balance sheet swelled to over $100 billion, but their actual equity was a tiny sliver of that. On top of this, they were dealing in derivatives, financial instruments whose notional value, the underlying value of the assets they controlled, was over $1 trillion. $1 trillion. It was a sum so vast it was difficult to comprehend, a portfolio of risk so large that its shockwaves could be felt in every corner of the globe. For a few years, it worked like magic. They generated returns of over 40% per year, returns that made even the best hedge funds in the world look amateurish. Investors, mesmerized by the intellectual firepower and the incredible profits, lined up to give them money. But Warren Buffett, watching from his quiet office in Omaha, was not impressed. He saw it for what it was: a group of geniuses picking up nickels in front of a steamroller. They were taking a near certainty and, by adding massive leverage, transforming it into a remote possibility of total ruin. Then, on August 17, 1998, the steamroller arrived. Russia, a country they had believed was too big to fail, defaulted on its domestic bonds. It was a black swan event, something their models, based on historical data, had calculated was a 10 sigma event, a statistical impossibility that should only happen once in the history of the universe. The flight to safety was immediate and global. Investors dumped risky assets and piled into the safest U.S. Treasury bonds. The tiny spreads that LTCM had bet on converging suddenly, violently, diverged. Instead of narrowing, they blew out to unprecedented levels. Every position they held started to hemorrhage money. And because of their massive leverage, the small losses were magnified into catastrophic ones. In a single day in August, they lost over $500 million. By the end of the month, they had lost nearly $2 billion. The phone calls started. Their lenders, the big Wall Street banks, were getting nervous. They issued margin calls, demanding more collateral to back the loans. But LTCM didn't have it. To raise cash, they had to start selling their assets. But because their positions were so huge, their selling just drove prices down further, accelerating their own losses in a terrifying death spiral. The geniuses were trapped. They were being forced to liquidate at the worst possible prices, at the worst possible time. The situation grew so dire that the Federal Reserve of New York, fearing that LTCM's collapse would trigger a chain reaction of defaults among its Wall Street lenders and freeze the entire credit system, had to intervene. The Fed brokered an unprecedented $3.5 billion bailout, organized by a consortium of the very banks that had lent LTCM the money. Warren Buffett was invited to be part of that consortium. He flew to New York and, in his characteristically straightforward way, offered to buy the entire portfolio for a fraction of its former value, a lowball offer that was ultimately rejected. But his presence there was a testament to his philosophy. While the geniuses were being wiped out by their own brilliance and borrowed money, the simple man from Omaha, who had always avoided leverage, was in a position to be the lender of last resort. He later summarized the lesson of LTCM with a quote that should be etched into the brain of every investor: "If you're smart, you don't need it. If you're dumb, you have no business using it." Leverage, he understood, is a gun with one bullet in the chamber pointed at your own head. You might pull the trigger 5 times and hear a harmless click, feeling richer and smarter each time. But the 6th time, it will blow your brains out. And there is no coming back from that. The psychological pull of leverage is one of the most powerful and insidious forces in human nature. It preys directly on our cognitive wiring, exploiting biases that have been honed over millennia of evolution but are disastrously unsuited for modern financial markets. The primary culprit is a concept from behavioral economics known as prospect theory. developed by Daniel Kahneman and Amos Tversky. Prospect theory shows that we don't process gains and losses symmetrically. The pain of a loss is felt roughly twice as intensely as the pleasure of an equivalent gain. This is loss aversion. But the theory also reveals something else. Our attitude toward risk changes depending on whether we are in the domain of gains or the domain of losses. When we are considering a potential gain, we tend to be risk-averse. We'd rather take a sure $500 than a 50% chance at $1,000. However, when we are facing a potential loss, we become risk-seeking. We'd rather take a 50% chance of losing $1,000 than accept a sure loss of $500. Leverage completely hijacks this system. It presents the intoxicating possibility of asymmetric upside, a small amount of capital controlling a large asset, promising magnificent gains. This taps directly into our greed and our desire to get rich quick. It feels like a shortcut. But this is an illusion. While it magnifies gains, it magnifies the potential for loss far more brutally. A 50% drop in an unleveraged stock position is painful, but you still own the asset. It can recover. A 50% drop in a position that is 2-to-1 leveraged is a 100% loss. You are wiped out. Game over. You are forced into the domain of losses, where your natural tendency is to take even more risks to get back to even, compounding the initial error. This is why you see traders doubling down on losing leveraged positions, a desperate, risk-seeking behavior that almost always ends in ruin. Another powerful psychological trap at play is the house money effect. When an investor makes some initial profits, especially with leverage, they cease to view those winnings as their own money. It feels like house money, and they become far more willing to take extreme risks with it. They feel invincible. This is precisely what happened to the partners at LTCM. Their early, spectacular returns created an aura of invincibility, a deep-seated overconfidence bias. They believed their models were perfect, and their intellect was a shield against risk. They were playing with what felt like house money, forgetting that a market crash would not distinguish between their initial capital and their winnings. It would take it all. The very structure of a margin loan is designed to exploit our worst instincts. The broker is happy to lend you money when the market is going up, fueling your greed. But the moment the market turns, they are ruthless. The margin call is not a polite request. It's an automated, emotionless executioner. It forces you to sell at the very moment your loss aversion is at its peak, when the pain is most acute, and when a rational, long-term investor should be considering buying, not selling. It robs you of your agency and your ability to wait for a recovery, turning a temporary paper loss into a permanent, devastating loss of capital. Understanding this psychology is the first step to building immunity. You must recognize that the desire to use leverage is not a rational calculation. It is an emotional craving, a siren song luring your financial ship onto the rocks. So how do we translate this understanding into a concrete, applicable tool? We need a mental model, a practical blueprint for decision-making that acts as a circuit breaker against this destructive impulse. The most effective one is what I call the sleep at night test. It's a simple, qualitative stress test you must run before making any investment decision, particularly one that involves any form of borrowed money, be it a margin loan, options, or even taking on too much debt in a business venture. The test is not about complex financial modeling. It is about confronting the brutal reality of a worst-case scenario. The first step is to calculate your true, unadulterated financial position. This isn't just your brokerage account value. This is a personal balance sheet. On one side, list all your assets, your stocks, your home equity, your cash. On the other side, list all your liabilities, your mortgage, your car loans, and most critically, any margin debt or money borrowed for investment purposes. The number you are looking for is your true net worth, the amount you would have left if you had to liquidate everything tomorrow to pay off your debts. This number is your financial foundation. The second step is the stress test itself. You must ask yourself a series of brutal what-if questions. What if the stock market crashes 50% next month, as it has multiple times in history? Look at your leveraged positions. A 50% drop in the underlying asset would trigger a 100% loss in a 2x leveraged position. Are you wiped out? Would this trigger a margin call? A margin call isn't a theoretical concept. It means your broker will, without your permission, sell your other non-leveraged holdings, your best stocks, your long-term investments, at fire sale prices to cover your debt. You must visualize this. Picture your shares of a great company like Apple or Microsoft being sold off at the bottom of a market panic simply to cover a speculative bet gone wrong. Does this forced liquidation threaten your ability to pay your mortgage? Does it impact your family's financial security? Does it steal your peace of mind? The third and final step is the rule of action. If the answer to any of these questions leads to a scenario of ruin, of being forced to sell, of having your core financial stability threatened, of losing sleep at night, then the leverage is unacceptable. Period. No exceptions. The potential upside, no matter how tantalizing, is not worth the risk of a catastrophic, unrecoverable loss. This mental model fundamentally reframes the investment objective. The goal of the 99% is to get rich quick. The goal of the professional, the Buffett-style investor, is to never be forced out of the game. The sleep-at-night test is a shield for capital preservation. It ensures that no single market event, no matter how severe, can deliver a knockout blow. It guarantees your survival, which is the non-negotiable prerequisite for long-term compounding and the eventual achievement of financial freedom. To truly appreciate the wisdom of this approach, we must examine its antithesis, the path walked by the 99% of market participants. This is the path of the modern retail investor, the Robin Hood gambler, who views the stock market not as a venue for partial ownership of businesses, but as a digital casino. Their world is one of YOLO trades, you only live once, where life savings are plowed into highly speculative call options on meme stocks. They are not investing. They are gambling on lottery tickets, hoping for a life-changing payout. Their community exists on social media platforms like Reddit's Wall Street Bets, where the currency is not diligent research, but loss porn and gain porn, screenshots of brokerage accounts showing either spectacular winnings or devastating losses. The emphasis is on the thrill of the action, the dopamine hit of a volatile price swing. Leverage is not a tool to be used with extreme caution. It is the fuel for the entire machine. They use margin loans to maximize their bets. They trade complex derivatives like weekly options, which are decaying assets that have an incredibly high probability of expiring worthless. They are drawn to leveraged ETFs that promise 2x or 3x the daily return of an index, not understanding that the daily rebalancing of these products makes them almost certain to lose money over the long term due to volatility decay. The psychology here is one of a desperate search for a shortcut. In a world of stagnant wages and rising costs, the idea of patiently compounding wealth over decades feels too slow, too boring. They want it now. The market becomes a source of hope, a potential escape from their economic reality. This emotional need makes them exquisitely vulnerable to manipulation and hype. They chase narratives, not numbers. A charismatic CEO, a revolutionary technology, a short squeeze. These are the stories that drive their decisions. They pile into stocks like GameStop or AMC, not because of a sober analysis of their business fundamentals, but because of a sense of tribal identity and a desire to stick it to the man. While some early participants in these manias do make life-changing money, the vast majority are the dumb money who arrive late, buying at the peak of the euphoria from those who are cashing out. They take on massive leverage at the top, and when the inevitable crash comes, they are utterly and completely wiped out. The consequences are not just financial. The permanent loss of capital is devastating. But the psychological toll is often worse. It breeds a deep cynicism about the market, a belief that the system is rigged. They retreat from investing altogether, missing out on the decades of legitimate, patient wealth creation that followed. They were swinging for a 500-foot home run, and not only did they strike out, they broke their bat and were ejected from the stadium for life. They chose fragility over robustness, and they paid the ultimate price. The impact of this choice is not an abstract concept. It is a mathematical certainty that can be seen directly on the financial statements of a company and more personally on the brokerage statement of an individual. For a corporation, leverage is represented by the debt-to-equity ratio on its balance sheet. A company with a high level of debt is inherently more fragile. During good economic times, that debt can amplify earnings and create impressive returns on equity. But during a recession, when revenues fall, the company must still make its interest payments. This fixed cost can quickly turn a small operating loss into a devastating net loss, potentially leading to bankruptcy. The debt holders get paid first, and the equity holders, the common stockholders, are often left with nothing. A business with no debt, like many of the companies Buffett prefers, can weather almost any economic storm. Its equity is robust. The same principle applies directly to an individual investor's portfolio. Margin debt is a liability on your personal balance sheet. Let's quantify the difference in outcomes with a simple, brutal example. Investor A has a $100,000 portfolio of stocks, fully paid for. Investor B has a $200,000 portfolio, but it's funded with the same $100,000 of their own capital and $100,000 borrowed on margin from their broker. They are 2-to-1 leveraged. Now a severe bear market hits, and the market drops by 50%. For Investor A, this is painful. Their portfolio is now worth $50,000. They have a paper loss of 50%, but they still own all their shares. They can wait. If the market eventually recovers back to its previous high, their portfolio will return to $100,000. They have survived. Now consider Investor B. Their $200,000 portfolio also drops by 50%. It is now worth $100,000. But they still owe the broker the $100,000 they borrowed. Their equity, their own capital, has gone from $100,000 to zero. They have been completely wiped out. A 50% decline in the market resulted in a 100% permanent loss of their capital. There is no recovery. There is no waiting for the market to come back. Their shares have been liquidated by the broker to pay back the loan. They are out of the game forever. This is not a complex idea. It is simple arithmetic. Avoiding leverage is the single most important act of risk management an investor can practice. It is the ultimate form of capital preservation. It is the non-negotiable foundation upon which all long-term portfolio growth is built. By refusing to play this game, you are making a conscious decision to prioritize survival over speed, robustness over short-term returns. You are building a financial fortress that cannot be breached by the madness of the market, ensuring you will be there to invest for decades to come. This brings us to the second unforced error, a mistake not of financial engineering, but of intellectual arrogance. The failure to respect the boundaries of one's own knowledge, the dangerous act of wandering outside your circle of competence. The scene is the late 1990s. The world was in the grips of a technological euphoria unlike anything seen before. The internet was changing everything, and a new breed of company, the dot-coms, was promising to revolutionize every industry on Earth. Valuations were untethered from reality. Companies with no profits, no revenues, and, in some cases, no finished products, were going public and achieving market capitalizations in the billions of dollars. It was a gold rush, and everyone was getting rich. Analysts who had built careers on valuing businesses based on boring old metrics like earnings and cash flow were ridiculed as relics of a bygone era. This time is different, was the mantra. Eyeballs, clicks, and market share were the new metrics that mattered. And in the middle of this frenzy stood Warren Buffett, looking like a dinosaur on the verge of extinction. He was being mercilessly criticized. The media, which had once lionized him as a genius, now painted him as an old man who had lost his touch. The influential financial magazine Barron's ran a scathing cover story in 1999, titled, "What's Wrong, Warren?" The article detailed how Berkshire Hathaway stock was dramatically underperforming the soaring NASDAQ index, how his refusal to invest in the hot tech and internet stocks was costing his shareholders dearly. The pressure was immense. His own shareholders were questioning him, his friends were urging him to get in on the action. It would have been easy to capitulate, to make a few token investments in some high-flying tech stocks just to show the world he got it. But Buffett did something remarkable. He did nothing. He publicly and repeatedly admitted, "I don't understand these businesses." He couldn't project their cash flows 10 or 20 years into the future. He couldn't identify their durable competitive advantages, their moats. How could you have a moat when the technological landscape was shifting under your feet every 6 months? He didn't know how to value a company like Pets.com, which was spending millions on Super Bowl ads to sell dog food online at a loss. He didn't understand how Webvan, a grocery delivery service, could be worth more than the established supermarket chains it was trying to replace, despite bleeding cash with every delivery. Because he couldn't understand them, he wouldn't invest. His rule was simple: if it's in the too hard pile, leave it there. He was defining and rigorously policing the border of his own circle of competence. Then, in March of 2000, the bubble burst. The Nasdaq index, which had peaked above 5,000, began a brutal, soul-crushing decline. Over the next 2.5 years, it would fall by nearly 80%. Trillions of dollars in paper wealth vanished into thin air. Companies that had been worth billions were suddenly bankrupt. Pets.com, Webvan, GeoCities. They became punchlines, symbols of the era's collective insanity. And what was Buffett doing? While the tech world was imploding, Berkshire Hathaway's portfolio of boring, understandable businesses, insurance companies, candy makers, furniture stores, just kept chugging along, generating predictable cash flows. More importantly, Buffett was sitting on a mountain of cash, the very cash he had been criticized for holding. He was now the one with the power, able to name his price as he picked through the wreckage, buying good assets from desperate sellers. His stand during the dot-com bubble is perhaps the single greatest real-world example of the power of the circle of competence. It wasn't about being smarter than everyone else. It was about having a more acute awareness of the limits of his own intelligence. He understood that the greatest danger for an investor is not ignorance, but the illusion of knowledge. By simply refusing to play a game he didn't understand, he avoided the catastrophic, permanent loss of capital that befell millions of others and emerged stronger than ever. The psychological forces that compel us to venture outside our circle of competence are deeply rooted in our social and cognitive makeup. The first and most powerful is the fear of missing out, or FOMO. We are social creatures, hardwired to feel anxiety when we see our peers succeeding at something we are not a part of. During the dot-com boom, people saw their neighbors, their friends, their barbers getting rich trading internet stocks. The feeling that you are being left behind is an excruciatingly painful one. It triggers a primal panic that overrides rational thought. You feel compelled to jump in, not because you've done the research, but because you can't stand the thought of being the only one not at the party. This emotional pressure is a powerful driver of poor investment decisions. Closely related to FOMO is the Dunning-Kruger effect, a cognitive bias wherein people with low ability in a particular domain tend to overestimate their competence. In investing, this is rampant. A novice investor might read a few articles about artificial intelligence, watch a couple of YouTube videos, and suddenly believe they have a deep understanding of the semiconductor industry. They mistake a superficial familiarity with a topic for genuine expertise. This illusion of knowledge is incredibly dangerous, because it gives them the confidence to make large bets in areas where they are, in reality, complete amateurs. They don't know what they don't know. They are unable to spot the red flags in a company's financial statements, they can't evaluate the quality of its management, and they have no real sense of its competitive position. They are simply buying a story, a popular narrative. This combination of FOMO and the Dunning-Kruger effect creates a toxic cocktail of emotional decision-making and intellectual overconfidence. It pushes investors into the most speculative and least understood corners of the market, where they become the patsies at the poker table. They are buying assets from insiders and experts who have a true information advantage, and they are almost certain to lose in the long run. Resisting this pull requires a rare form of intellectual humility. It requires the ability to say, "I don't know," and to be completely comfortable with that statement, even when the whole world is screaming that you're missing out. It's about knowing that the temporary pain of underperforming a speculative bubble is infinitely preferable to the permanent pain of being destroyed by its collapse. To operationalize this principle, to build a defense against our own psychological flaws, we need a robust mental model. The best framework for policing your circle of competence is the Teach a 12-year-old test. Before you invest a single dollar in any company, you must be able to pass this test. The rule is this: you must be able to explain the business, its competitive advantage, and its risks to an intelligent but uninformed 12-year-old in 5 minutes, using simple language, and have them understand it. If you can't, the company is outside your circle, and you must not invest. This test forces a level of clarity and simplicity that cuts through hype and complexity. The blueprint for applying this test has 4 key steps. Step 1. How, specifically, does this company make money? You must be able to articulate the exact product or service, who the customer is, and the transaction that moves money from their pocket to the company's. Is it selling a physical product, a subscription, advertising space? If you can't describe the core business model in 1 or 2 sentences, you don't understand it. Step 2. What is its durable competitive advantage? This is the moat that Buffett talks about. Why will this company be able to fend off competitors and earn high returns on capital for the next 10 to 20 years? The answer has to be specific. Is it a powerful brand, like Coca-Cola? Is it a network effect, like Facebook or Visa, where the service becomes more valuable as more people use it? Is it high switching costs, like the software that runs a bank's core operations? Is it a low-cost advantage, like Costco or Geico? If you can't clearly identify a strong, sustainable moat, then you are likely looking at a commodity business with no long-term pricing power. Step 3. Who is trying to destroy this business, and why won't they succeed? You must have a clear-eyed view of the competition. Who are the main rivals? What are their strengths and weaknesses? Why can't a well-funded new entrant, or a giant, like Amazon, come in and replicate what this company does and steal its profits? A thorough understanding of the competitive landscape is non-negotiable. Step 4. What are the primary risks? What could go wrong? Could a change in technology make their product obsolete? Could a change in regulation harm their profitability? Is the business overly dependent on a single key employee or a single large customer? You must be able to think like a pessimist and identify the key vulnerabilities. If you can confidently and simply answer all 4 of these questions, you have found a business that is likely within your circle of competence. This model isn't about finding the next big thing. It's about avoiding the big mistake. It filters out the vast universe of companies that are too complex, too speculative, or too difficult to understand, leaving you with a small, manageable group of potential investments where you have a genuine analytical edge. The antithesis of this disciplined approach is the expert in everything, a character archetype that represents the vast majority of retail investors. This individual's portfolio is not the result of a coherent investment strategy, but rather a chaotic collection of recent headlines and popular narratives. One month, they are an expert on Canadian cannabis stocks, convinced that legalization will create a new generation of millionaires. They buy in at the peak of the hype. A few months later, after those stocks have crashed, they've moved on. Now they are a blockchain evangelist, plowing money into obscure cryptocurrencies with fancy white papers they haven't read. When the crypto winter arrives, they pivot again, this time to AI startups, chasing the next NVIDIA. Their thought process is entirely driven by external cues. They are not conducting deep, bottom-up business analysis. They are trend following. They see a sector getting hot in the news. They see the stocks going up, and they feel the powerful pull of FOMO. They equate a rising stock price with a good business, a fundamental and often fatal error. This strategy of intellectual tourism guarantees one thing: you will always be the last person to the party. You are buying after the trend is well established, after the stock has already had a massive run-up. The people you are buying from are the early investors, the venture capitalists, the industry insiders, the people who actually are inside the circle of competence for that industry. They are the ones who understand the business dynamics, and they are happily selling their shares to you at inflated prices. The expert in everything is constantly transferring their wealth to the true specialists. Their portfolio experiences a series of boom and bust cycles, with each new fad leading to initial excitement followed by an inevitable crash. This path not only leads to poor financial returns but also to a state of constant anxiety and confusion. Because they have no deep conviction based on their own research, any small dip in the stock price creates panic. They have no anchor of intrinsic value to hold onto, so they are tossed about on the waves of market sentiment. It is a surefire recipe for long-term failure. The financial connection between staying within your circle of competence and achieving superior returns is direct and profound. It is the cornerstone of effective risk management. When you invest in a business you don't truly understand, you are incapable of accurately assessing the risks involved. You cannot distinguish between a temporary setback and a permanent impairment of the business's earning power. For example, if a company you own and understand, like See's Candies, has a bad quarter because of rising sugar prices, you can analyze the situation. You know the strength of the brand allows them to raise prices to offset the cost, and you can confidently hold or even buy more. But if a complex biotech company you own reports that a clinical trial for a new drug has failed, you have no way of knowing if this is a minor hiccup or a catastrophic event that invalidates the entire investment thesis. You are flying blind. This inability to properly assess risk leads to two common errors: overpaying for assets because you get caught up in a growth story you don't fully grasp, and panic selling at the first sign of trouble. Staying within your circle of competence solves this. It allows you to build a concentrated portfolio of high-conviction ideas. Instead of owning 50 different stocks you barely know, you can own 10 to 15 businesses you know inside and out. This concentration, backed by deep knowledge, is how real wealth is created. You have a genuine analytical edge. You can patiently wait for the market to offer you a price on one of your well-understood companies that is significantly below its intrinsic value. Because you know the business so well, you can act with courage and conviction when others are fearful. This discipline is the very engine of beating the market. You are not trying to be a genius who can predict the future of every industry. You are simply defining a small patch of ground where you are an expert, and you are waiting patiently for opportunities to arise within that patch. This leads us directly to the third unforced error, a mistake born not of ignorance but of impatience. The tyranny of activity. The deeply flawed belief that constant motion is the same as progress. In 1972, Warren Buffett and his partner Charlie Munger made an investment that would fundamentally alter their entire approach to capital allocation. They purchased a small, family-owned chocolate company based in California called See's Candies. The price was $25 million. On the surface, it seemed like an ordinary transaction. But the story of See's Candies within the Berkshire Hathaway empire is a masterclass in the power of the third item on the not-to-do list: avoiding frenetic, unnecessary activity. See's was a wonderful business. It was simple and understandable. It produced a high-quality product that customers loved. Most importantly, it had a powerful, latent pricing power derived from its brand. People bought See's chocolates for holidays and special occasions, and the emotional connection meant they were relatively insensitive to small price increases. After buying the company, what did Buffett, the genius stockpicker, do? He didn't try to time the market with it. He didn't sell it when the economy entered a brutal recession and stagflation period in the mid-1970s. He didn't look for a better candy company to trade into. He simply held it. For decades, he let the business do its work. That initial $25 million investment has since generated over $2 billion in pre-tax earnings for Berkshire Hathaway, most of which was sent to Omaha to be reinvested in other opportunities, C's became the prototype for the kind of business Buffett would look for from then on. A business so good that the best course of action was to do nothing at all. This principle of masterly inactivity is completely at odds with the culture of Wall Street. The entire financial industry is built on the premise of activity. Brokers want you to trade so they can earn commissions. Financial news networks need to create a sense of urgency and constant drama to keep you watching. Fund managers feel pressure to constantly shuffle their portfolios to justify their fees and prove they are actively managing your money. The result is a deafening cacophony of noise urging you to do something. Buy this, sell that, rebalance, rotate sectors. Buffett's experience with C's candies taught him that this is almost always a mistake. Once you have identified and purchased a piece of a truly wonderful business at a fair price, the single most profitable thing you can do is sit on your hands. The constant tinkering, the endless search for the next hot stock, the feeling that you must always be making moves, this is the tyranny of activity, and it is a massive destroyer of long-term wealth. The psychological force driving this compulsion for constant action is known as, quote, action bias. It is our innate tendency to favor action over inaction, even when there is no rational evidence to suggest that acting will lead to a better outcome. In our evolutionary past, this bias was a survival mechanism. If you heard a rustle in the bushes, it was safer to act, to run or prepare to fight, than to do nothing and risk being eaten by a predator. But in the world of long-term investing, this instinct is a liability. The stock market is not a jungle where instant reactions are required. It is a garden that requires patience and time to grow. We see a stock in our portfolio drop by 10%, and action bias screams, "Sell! Do something to stop the pain." We read an article about a new technology, and action bias whispers, "Buy! You have to get in on this now." This is compounded by the illusion of control, another cognitive bias where we believe we can influence outcomes that are actually beyond our control. By constantly trading, rebalancing, and tinkering with our portfolios, we create the feeling that we are actively managing our financial destiny. We feel like we are the pilot of the plane, skillfully navigating the turbulence. In reality, we are often just a passenger in the back, randomly pushing buttons and pulling levers, increasing the friction and drag on the aircraft without having any real effect on its direction. The financial media is a massive catalyst for this bias. The blinking red and green numbers on the screen, the breaking news alerts, the breathless commentary from analysts. It's all designed to trigger your fight-or-flight response, to make you feel that you must react immediately to every new piece of information. The truth is that 99% of financial news is just noise. It has no bearing on the long-term earning power of the businesses you own. By reacting to it, you are allowing short-term sentiment to dictate your long-term strategy, a surefire recipe for failure. Overcoming action bias requires a conscious and deliberate shift in mindset. You must learn to equate intelligence not with frantic activity, but with disciplined patience. You must find a way to unplug from the noise machine and focus only on what truly matters, the underlying performance of the businesses in your portfolio. To cultivate this discipline of patience, Buffett offers a powerful and clarifying mental model, the 20-slot punch card rule. He advises investors to imagine that at the beginning of their investing lifetime, they are given a punch card with only 20 slots in it. These 20 punches represent the total number of investments they are allowed to make in their entire life. Once they have made 20 investments, they can't make any more. This simple thought experiment has a profound effect on behavior. It immediately raises the bar for what qualifies as an investment. Suddenly, the idea of using one of your precious 20 slots on a speculative, mediocre idea becomes unthinkable. The blueprint for applying this model is as follows. First, before making any investment, you must ask yourself, is this opportunity so good, so compelling, and so well understood by me that I am willing to use one of my 20 lifetime punches on it? This question alone will filter out the vast majority of get-rich-quick ideas and market fads. It forces you to move from a mindset of speculation to a mindset of true ownership. Second, the punch card model forces you to think long-term. If you only have 20 chances, you're not going to waste one on a stock you plan to flip in 6 months. You are going to look for businesses that you would be happy to own for 10, 20, or even 50 years. You are looking for a partner in a business, not a temporary tenant in a stock. This naturally aligns your thinking with the long-term compounding of value in the underlying enterprise, rather than the short-term fluctuations of its stock price. Third, it instills a powerful sense of concentration. Instead of diversifying into hundreds of stocks you know nothing about, diversification, as Peter Lynch called it, the punch card model encourages you to make a few large, high-conviction bets in businesses that you have researched exhaustively and understand deeply. This is how fortunes are made. Wealth is created by finding a handful of truly exceptional opportunities and investing significantly in them. The 20-slot punch card is not a literal rule, but a psychological tool. It is a mechanism for enforcing discipline, fighting action bias, and elevating the quality of your investment decisions. It transforms you from a frantic trader into a patient, deliberate business owner. The antithesis to this patient approach is the day trader's fallacy. This is the belief, held by a surprisingly large number of people, that they can consistently profit from the market's small, intraday price movements. The day trader's life is the epitome of frantic activity. They are glued to their screens from the market's open to its close, surrounded by complex charts, streaming news feeds, and technical indicators. They believe that by analyzing patterns in price and volume, they can predict the market's next move on a minute-by-minute or even second-by-second basis. They are engaged in a high-stress, zero-sum game against other traders, high-frequency trading algorithms, and market makers. What the novice day trader fails to appreciate are the two silent killers that make this game almost impossible to win over the long term: costs and taxes. Every time a day trader makes a trade, buying or selling, they incur costs. There might be a direct commission paid to the broker. More insidiously, there is the bid-ask spread, which is the small difference between the price at which you can buy a stock and the price at which you can sell it. This spread is a hidden transaction cost that goes to the market makers. While it may only be a few pennies per share, when you are trading hundreds of times a day, these small costs add up to a massive drag on your performance. It's like trying to run a race while carrying a leaky bucket of water. The constant friction drains your resources. The second killer is taxes. In the United States, investment gains are taxed differently depending on how long you hold the asset. If you hold an investment for more than a year, any profit is considered a long-term capital gain and is taxed at a preferential rate, which is currently 0%, 15%, or 20% for most people. However, if you hold an investment for a year or less, any profit is considered a short-term capital gain and is taxed at your ordinary income tax rate, which can be as high as 37%. The day trader's entire strategy is based on short-term holding periods, meaning that any profits they do manage to eke out are subject to the highest possible tax rates. The government becomes a senior partner in their winnings, while their losses are their own. When you combine the constant friction of trading costs with the heavy burden of short-term capital gains taxes, the mathematical hurdle for a day trader to achieve a net profit becomes extraordinarily high. They are confusing motion with progress, and in the end, their frantic activity serves only to enrich their brokers and the government. The direct financial connection between masterly inactivity and superior portfolio growth is one of the most powerful mathematical forces in the universe, the magic of compounding uninterrupted. Let's break down how activity destroys this magic. When you trade frequently, you are constantly incurring costs. These costs, commissions, and bid-ask spreads, are a direct, immediate reduction of your capital. They are a guaranteed loss that you must overcome just to break even. But the more significant damage is done by taxes. Imagine you own a stock that doubles in value over a year, from $10,000 to $20,000. If you sell it, you realize a $10,000 short-term capital gain. Assuming a 30% tax rate, you immediately owe $3,000 to the government. You are now left with only $17,000 to reinvest. You have voluntarily given away 15% of your total capital. Now consider the alternative. You own the same stock, it doubles to $20,000, and you do nothing. You sell nothing, your tax bill is zero. Your entire $20,000 remains invested and working for you. This untaxed gain can now compound on a larger capital base. By simply being inactive, you allow your capital to grow in a tax-deferred environment, much like a traditional IRA or 401k. The longer you can let your winners run without selling and triggering a tax event, the more powerful this effect becomes. Albert Einstein supposedly called compound interest the eighth wonder of the world. But the fuel for the compounding engine is time. Every time you trade, you interrupt the process. You reset the clock. Buffett's genius was in recognizing that finding a wonderful business was only half the battle. The other, equally important half, was having the discipline to let that business compound value for decades without interruption. This focus on inactivity is not about being lazy. It's about being smart. It's about recognizing that in investing, your greatest enemy is often yourself, your impatience, your biases, and your compulsion to act. By conquering this enemy, you unlock the full, explosive power of long-term capital growth. This naturally leads to the fourth great unforced error, the failure to master one's own emotions in the face of the market's wild and unpredictable mood swings. In the tumultuous years of 1973 and 1974, the American stock market was in the midst of a brutal, grinding bear market. The country was reeling from the Watergate scandal, the resignation of a president, and the OPEC oil embargo, which had sent energy prices soaring and tipped the economy into a deep recession. Fear and pessimism were rampant. The mood on Wall Street was apocalyptic. Investors were dumping stocks indiscriminately, desperate to get out at any price. During this period of maximum gloom, the stock of one of America's premier media companies, the Washington Post, was getting crushed along with everything else. The company itself was fundamentally sound. It had a dominant newspaper in a major city, owned several television stations, and was a high-quality, cash-generative business. But in the panic, its stock price had been driven down to a level that was completely disconnected from its underlying business value. The market capitalization of the entire company fell to just $80 million. Warren Buffett, sitting in Omaha, was watching this unfold. He knew the Washington Post company intimately. He had read its annual reports for years. He understood its business model, its competitive moat, and its management, led by the formidable Katharine Graham. And he did a simple calculation. He conservatively estimated that the intrinsic value of the company's assets, if sold off individually, was at least $400 million, and likely more. Yet, here was the stock market, in a fit of depression, offering to sell him the entire business for $80 million. He was being offered the chance to buy dollars for 20 cents. While the rest of the world was panicking and selling, Buffett saw the market's fear not as a risk, but as a magnificent opportunity. He began buying the Washington Post stock aggressively. He invested nearly $11 million, a significant portion of his partnership's capital at the time, to acquire a large stake in the company. People thought he was insane. Why was he buying a newspaper stock in the middle of a recession? But Buffett wasn't buying a stock. He was buying a piece of a wonderful business at a ridiculously cheap price. He famously told a reporter at the time that he felt like an oversexed man in a harem. That investment in the Washington Post would become one of the most successful of his career. That $11 million stake would eventually grow to be worth well over $1 billion, a 100-fold return. This story is the quintessential illustration of Buffett's framework for dealing with market volatility, a framework he learned from his mentor, Benjamin Graham. It's the allegory of Mr. Market. To protect ourselves from the emotional roller coaster of the stock market, Graham and Buffett created a powerful personification. They ask you to imagine that you are a partner in a private business, and your only other partner is a man named Mr. Market. Every day, Mr. Market shows up at your door and offers to either buy your share of the business or sell you his share. The critical thing to understand about Mr. Market is that he is a manic depressive. Some days, he is euphoric. He sees nothing but a rosy future for your business and offers to buy your share at a ridiculously high price. Other days he is utterly despondent. He is consumed by fear and pessimism, convinced the business is on the verge of collapse, and he offers to sell you his share at an absurdly low price. You, as the rational partner, have a choice. You are never obligated to trade with him. If you think his quoted price is silly, you are free to ignore him and go about your day, confident in the long-term value of your business. You only interact with him when his mood serves your interest. When he is euphoric and offers you a crazy high price, you have the option to sell your share to him. When he is despondent and offers you a bargain basement price, you have the option to buy his share. This simple allegory is a profound psychological tool. It reframes the very nature of market volatility. For most people, a falling stock market is a source of fear and anxiety. It feels like you are losing money. But through the lens of the Mr. Market allegory, a falling market is a gift. It is your manic depressive partner showing up at your door in a panic, offering to sell you his share of a great business at a deep discount. A rising market for the long-term buyer isn't necessarily good news. It's Mr. Market getting greedy and offering you less attractive prices. This mental model severs the dangerous emotional link between stock prices and your own sense of well-being. The market's daily quotes are not a judgment on your intelligence or the value of your holdings. They are simply the emotional ramblings of your irrational business partner. Your job is to ignore the noise and focus on the one thing that matters, the intrinsic value of the business. You use his emotional outbursts as opportunities, not as a guide for your own actions. The psychological biases that Mr. Market preys upon are among the most powerful in our mental arsenal. The first is herd mentality, also known as social proof. As social animals, we have a deep-seated instinct to follow the crowd. In ancient times, if everyone in your tribe suddenly started running, it was a good survival strategy to start running too and ask questions later. In financial markets, this instinct is deadly. When a stock or a sector is soaring, and everyone is talking about it, the pressure to join the herd and buy becomes almost irresistible. We assume that if so many people are buying, they must know something we don't. This leads to buying at the top of bubbles. The same is true on the downside. When a market crashes and panic sets in, our instinct is to sell because everyone else is selling. We are wired to run with the herd, right off the cliff. The second bias is myopic loss aversion. As we discussed earlier, we feel the pain of a loss twice as acutely as the pleasure of a gain. Myopic refers to our tendency to check our portfolios far too frequently. This combination is lethal. If you check your portfolio every day, you are subjecting yourself to a constant stream of small losses, each one delivering a sharp sting of psychological pain. This accumulation of pain wears down your resolve, making you far more likely to capitulate and sell during a downturn, locking in a temporary loss and turning it into a permanent one. Mr. Market is the embodiment of these two biases. His euphoria represents the peak of the herd's greed, and his depression represents the trough of the herd's fear. By externalizing these forces into a single, flawed character, you can begin to distance yourself from them. You can observe the herd's behavior objectively, rather than being swept up in it. You can recognize that the pain you feel from a falling stock price is an irrational response, amplified by myopic loss aversion, and not a signal that your investment thesis is wrong. Mastering this mental game is the true key to beating the market. You must cultivate the emotional discipline to be greedy when others are fearful, and fearful when others are greedy. The antithesis of the investor who has mastered Mr. Market is the quote watcher. This individual lives and dies by the daily fluctuations of the stock market ticker. Their brokerage app is on the front page of their smartphone, and they check it dozens if not hundreds of times a day. Their emotional state is directly tethered to the red and green numbers on the screen. If their portfolio is up for the day, they feel smart, confident, and euphoric. If it's down, they feel anxious, regretful, and panicked. They have completely abdicated their role as a rational, long-term business owner and have become a slave to Mr. Market's every whim. For the quote watcher, a stock price is not an offer from an irrational partner. It is a grade on their performance. A falling price is a failing grade. a signal that they have made a mistake and must correct it immediately by selling. A rising price in a stock they don't own is a sign they are missing out, triggering intense FOMO and the urge to chase the momentum. This person has no anchor. Their decision-making is purely reactive, driven by the two most destructive emotions in investing: fear and greed. They are guaranteed to buy high and sell low. They will be swept up in every bubble and panic sold at the bottom of every crash. They may have a high IQ, a prestigious degree, and a successful career, but in the domain of investing, their emotional reactivity makes them the dumb money that provides the profits for the patient, rational investors. The irony is that the technology that was supposed to empower the retail investor, the instant access to quotes, the zero-commission trading apps, has in many ways made them more vulnerable. It has turned investing into a high-frequency video game, amplifying our worst behavioral biases and making it harder than ever to adopt the long-term, detached perspective that is essential for success. The quote watcher is playing a game they cannot win because they have made Mr. Market their master, not their servant. The direct financial connection of this principle is where the rubber truly meets the road. It is the mechanism by which long-term outperformance is generated. The market return, such as the average annual return of the S&P 500, is just that, an average. It is the blended result of all the participants' actions, including all the euphoric buying at the tops and all the panic selling at the bottoms. By definition, if you can systematically act as the counterparty to these emotionally driven mistakes, you will achieve returns that are superior to the average. This is the very definition of beating the market. When Mr. Market, in a fit of panic during a recession, offers to sell you shares in a solid, profitable company for 50 cents on the dollar, and you have the cash and the courage to buy, you are locking in a massive potential future return. The value of the business hasn't been cut in half. Only its price has. As the economy and market sentiment inevitably recover, the price will eventually converge with the business's intrinsic value, delivering a huge capital gain to you. You have systematically transferred wealth from the fearful seller to yourself. Conversely, when Mr. Market gets wildly euphoric about a particular stock or sector and offers you a price that is 2 or 3 times the business's underlying value, you have the opportunity to sell and realize that gain. You are transferring your overpriced shares to the greedy, late-to-the-party buyer. This discipline of using market volatility as an opportunity rather than a threat is the single most powerful source of alpha or excess returns. It is not about predicting the market's next move. It is about knowing the value of what you own and being psychologically prepared to act when the market's price deviates significantly from that value. This is how Buffett made his fortune. It wasn't by discovering secret companies no one had ever heard of. It was by patiently waiting for the market to misprice wonderful, well-known businesses like the Washington Post, Coca-Cola, or American Express, and then buying them with conviction when no one else would. This leads us to the fifth and final unforced error, a subtle but crucial mistake that separates the good investor from the great one. The failure to distinguish between a wonderful business and a wonderful investment, the fallacy of forgetting that the price you pay determines your return. One of the most ironic stories in Warren Buffett's career, and one of his most formative mistakes, was the very investment that gave his legendary company its name, Berkshire Hathaway. In the early 1960s, Buffett was operating as a cigar butt investor, a strategy he learned directly from Ben Graham. The idea was to find companies that were trading for less than their net working capital. Essentially, businesses so cheap that you could buy them, liquidate all the assets, pay off all the debts, and still walk away with a profit. It was like finding a used cigar on the ground with one last free puff left in it. Berkshire Hathaway was a struggling New England textile mill, a relic of a dying industry, but its stock was dirt cheap, a classic cigar butt. Buffett started buying shares. The company was constantly closing mills, and after each closure, it would use the proceeds to buy back its own shares through a tender offer. Buffett had a verbal agreement with the CEO, Seabury Stanton, that the next tender offer would be at a specific price. When the official offer came in writing, Stanton had lowered the price by a tiny fraction. Buffett, feeling cheated and angry, did something completely out of character. Instead of taking the small profit and moving on, he got emotional. He started buying Berkshire Hathaway stock aggressively, not to make money, but out of spite. He bought enough to take control of the company, and his first act as the new owner was to fire Seabury Stanton. Buffett now found himself in charge of a terrible business in a dying industry. For the next 20 years, he was forced to pour good money after bad, investing millions of dollars into the textile operations just to keep them afloat, all while the business continued its slow, inevitable decline. He later called this his $200 billion mistake. That's the amount of money he calculated he had lost over the decades by tying up his capital in a lousy business instead of investing it from the start in the wonderful businesses he later came to own. The experience taught him the most important lesson of his career, a lesson that marked his evolution from a Graham-style cigar-butt investor to the Buffett we know today. He realized that a cheap price could not turn a bad business into a good investment. As he famously said, "It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price." This final unforced error is the failure to appreciate that price and value are two different things, and the price you pay is the single biggest determinant of your future returns. The psychological trap that leads investors to overpay for assets is the narrative fallacy. Coined by Nassim Nicholas Taleb, this is our tendency to be swayed by a compelling story rather than by empirical facts and data. We are wired to respond to narratives. A company with a charismatic, visionary CEO, a revolutionary product that promises to change the world, and a stock price that is going up every day creates an incredibly powerful and seductive story. Think of companies like Tesla in recent years, or the Nifty 50 growth stocks of the 1970s. Investors fall in love with the story. They become emotionally attached to the company's mission and its success. Once we have bought into a narrative, another powerful bias kicks in: confirmation bias. We actively seek out information that confirms our belief in the story, and we dismiss or ignore any information that contradicts it. We read the glowing analyst reports and watch the fawning interviews with the CEO, while we disregard the fine print in the annual report that shows slowing growth or deteriorating margins. We see the sky-high valuation not as a sign of risk but as proof that the company is truly special. We are no longer making a rational investment decision based on a sober assessment of price versus value. We are participating in a belief system. The mantra of this investor is growth at any price. They find a wonderful, innovative, fast-growing company, and they buy it without any regard for its valuation. They tell themselves that quality is never expensive, or you have to pay up for the best. They confuse a great company with a great stock, failing to understand that these are not the same thing. A company can continue to perform brilliantly, growing its earnings and revenues for years, but if you paid too high a price for its stock, your investment returns can be flat or even negative for a very long time. You have fallen for the narrative and forgotten the math. To guard against this fallacy, we need a final mental model, the bedrock principle of all value investing, the margin of safety. Popularized by Benjamin Graham, the margin of safety is the difference between the intrinsic value of a business and the price you pay for it in the market. It is the buffer that protects you from the uncertainties of the future. The blueprint for applying this model has 3 steps. The first and most difficult step is to calculate the intrinsic value of the business. Intrinsic value is the discounted value of all the cash that can be taken out of a business during its remaining life. There are many ways to estimate this, from complex discounted cash flow (DCF) models to simpler heuristics like applying a conservative price-to-earnings multiple based on the company's historical average and the industry it operates in. The exact number is not what's important. What's important is to have a rational, conservative estimate of what the entire business is worth, independent of its current stock price. Let's say you analyze a company and conclude that its intrinsic value is approximately $100 per share, The second step is to demand a discount. This is your margin of safety. You will not buy the stock at its intrinsic value of $100. You will not buy it at $90. You might establish a rule for yourself that you will only buy when the price is at least 30% below your estimated value. In this case, your buy price would be $70 or less. This discount, this gap between value and price, is the core of the strategy. The third step is to understand what this margin of safety accomplishes. It is not just about getting a bargain. It provides protection from three critical risks. First, it protects you from errors in your own valuation. Your estimate of intrinsic value is just that, an estimate. It could be wrong. The margin of safety gives you room to be wrong and still not lose money. Second, it protects you from bad luck or unforeseen negative events. The future is uncertain. A great company can face a new competitor, a recession, or a technological disruption. The margin of safety acts as a shock absorber against these future troubles. Third, it protects you from the volatility of the market itself. By buying at a significant discount, you create a powerful tailwind for your investment. The price is more likely to rise toward its intrinsic value than to fall further away from it. The margin of safety is the engineer's approach to investing. It's like building a bridge that can hold 10 times the expected weight. It's the ultimate defense against a future you cannot predict. The antithesis of this disciplined, price-conscious approach is the growth-at-any-price investor. This person's philosophy was perfectly captured during the Nifty 50 era of the early 1970s. The Nifty 50 were a group of about 50 large-cap blue-chip stocks that were considered one-decision stocks. You just had to buy them and hold them forever. These were wonderful companies, names like Xerox, Polaroid, IBM, and McDonald's. They were the dominant, fast-growing market leaders of their day. The problem was that their popularity drove their stock prices to astronomical levels. It was not uncommon for these stocks to trade at 50, 80, or even 100 times their annual earnings. The narrative was that their growth was so certain and so rapid that no price was too high to pay. This belief was shattered by the brutal bear market of 1973-74. While these were great companies, their stocks got annihilated. Xerox fell by over 70%. Polaroid fell by over 90%. An investor who bought these wonderful companies at their peak in 1972 saw their investment go nowhere for over a decade, even as the businesses themselves continued to grow. They made the classic mistake of confusing a good company with a good investment. They paid for decades of future growth in advance, and their returns suffered accordingly. This is a lesson that every generation of investors seems to have to learn the hard way. We saw it with the dot-com stocks in 2000. We saw it again with many of the high-flying story stocks in the bull market of the last decade. The names change, but the behavior is the same. Investors fall in love with a narrative, abandon all valuation discipline, and pay a price that makes a positive future return almost mathematically impossible. They forget Buffett's hard-won lesson from his Berkshire Hathaway textile mistake. The price you pay is paramount. The direct financial connection here is the most fundamental equation in investing. Your future return is a function of the price you pay today. Specifically, the earnings yield of your investment, the company's earnings per share divided by the price you paid per share, is a strong predictor of your long-term returns. Let's make this tangible. If you buy a stock with a price-to-earnings PE ratio of 50, your initial earnings yield is just 2%, 1 divided by 50. This means that for every dollar you invest, the underlying business is generating only 2 cents of profit for you. For you to earn a satisfactory return, say 10% per year, the business's earnings will have to grow at an absolutely heroic rate for a very long time, just to justify the high price you paid. You have a massive headwind working against you from day one. Now contrast this with buying a similarly high-quality business when it is out of favor and trades at a PE ratio of 15. Your initial earnings yield is now 6.7%, 1 divided by 15. You have a much higher starting return, and any future growth in the business is a bonus on top of that. You have a powerful tailwind at your back. Insisting on a margin of safety is simply a systematic way of ensuring you are always buying stocks with a high initial earnings yield relative to their quality and growth prospects. It is how you lock in your potential for superior capital gains at the moment of purchase, not by hoping for some future event. It is the final and most crucial piece of the not-to-do list. You must not overpay, even for the best business in the world. By avoiding this final unforced error, you complete the defensive fortress around your portfolio. You have avoided leverage, you have stayed within your circle of competence, you have resisted the urge for frantic activity, you have mastered your emotions, and you have refused to overpay. You have now put the odds of long-term success overwhelmingly in your favor. You have just spent this time installing a powerful and incredibly rare piece of operating software into your mind. It is the unforced error avoidance protocol. You now possess the 5 core principles that separate the 1% of successful long-term investors from the 99% who are destined for mediocrity or ruin. You understand that survival is the foundation of success, that avoiding the single knockout blow is more important than landing 100 small jabs. This is a mental toolkit that shields your capital and your sanity from the madness of the crowd. But this protocol, this relentless focus on what not time to do, is only one half of the equation. It is the impenetrable defense, the shield that guarantees you stay in the game. The other half is the offense. It is the specific, actionable criteria that Warren Buffett uses when he does decide it's time to swing the bat. Knowing what to avoid is critical, but knowing what to look for, the specific characteristics of a truly wonderful business, the qualitative factors that create a deep and wide economic moat, that is how you move from merely surviving to truly thriving. This defensive framework you've just mastered is what gets you to the championship game, but the video that is now appearing on your screen, that is the offensive playbook. It is the missing link. It bridges the critical gap between not losing and winning big. It connects the discipline of the not-to-do list with the opportunism required to build generational wealth. It takes the capital you have so carefully preserved and shows you exactly where to deploy it for maximum long-term compounding. This journey of intellectual mastery is not for everyone. It's for the serious player, the entrepreneur of their own financial life, the individual who is truly committed to the craft of wealth building and the achievement of unshakable financial freedom. If that is you, then your next step is clear, the map is incomplete. Complete the arsenal. Continue your ascent. Click the video.